David Holt here again, and thanks for clicking on the link to learn more about the Intrinsic Value portfolio. So as always, I'm eager to walk through another portfolio option that we have here at CFRA and why we think Intrinsic Value could make a good fit for your investment strategy. So kicking it off with the agenda, first we'll quickly touch on an overview of model portfolios and why you, as a user, might want to look at these options for potential investment ideas. Additionally, we'll get into details around the intrinsic value model portfolio itself, including how it operates, current sector weights, and the actual screening process. Lastly, we'll take a closer look at how the portfolio has held up in the face of recent market volatility as of late. As I've stressed in prior videos, the key takeaway from this slide is these model portfolios are designed to help you as a client. And that's really to uncover investment ideas and ultimately provide acceptable risk-adjusted returns. So in total, we have 15 stock and ETF solutions available, with 5 that are actively managed by the portfolio committee, and then 4 rules-based portfolios. So we really feel that this wide selection can provide solutions for all market situations and investor types. So why look at rules-based portfolios? With some help from Todd Rosenbluth, head of ETF and mutual fund research here at CFRA, we looked at how active managers have done over the past 4 months of 2020. So according to the S&P Dow Jones Indices, only 36% of active equity funds in domestic regions have outperformed their bench during the first 4 months of the year. So this is only up slightly from a 1, 3, and 5-year time span, and that's despite the increased market volatility, which should be a setting where most active approaches have a better chance of outperforming. Although the data does get better as you move from left to right on this slide, as you can see, it really does take a well-orchestrated approach to consistently outperform benchmarks with an active strategy. So the intrinsic value portfolio has one of the more storied histories. It was originally created in February of 1995. It's very important to note, intrinsic value is a quantitative rules-based model portfolio that's revisited twice per year in the spring and fall. Names are added or removed based on specific investment criteria, which I'll get into a little later. The number of holdings usually hover around 50 to 60 names, but have been as high as 90 in the past, and it really depends on how many names meet the specified criteria for the given rebalance period. So the portfolio just went through its spring rebalance and, for example, has currently 53 names. So next up, we have current sector weights, and I've really just tried to articulate where we are underweight and overweight here. You can see that the portfolio has a natural tilt towards technology, which has served the portfolio well so far in 2020, and it's really been the main culprit of recent outperformance. So likewise, the strategy has helped avoid some of the hardest hit areas of the market from COVID-19, such as the consumer discretionary sector. Here we really try to map out the process of portfolio additions and eliminations from a higher level perspective. And that's so you, as a client, really understand how we execute on this specific strategy. So starting at the top orange bar on this slide, we have the main overarching goals for this portfolio, which is value creation and risk management. Next, as the semi-annual balance period does approach in September and March of every year, we apply our screening tool to narrow down potential candidates. So lastly, we add or remove names that do or don't meet the screening criteria. And then on the left-hand portion of this slide, we've listed some outputs, which are recent additions to this portfolio. So here I'll cycle through the screening criteria that we use to extract what we believe to be the true intrinsic value of specific stocks. So we think this increases the chance to provide investment ideas that could have some potential disconnect to where they are trading today. So first up, we have free cash flow. Levels need to be at least $250 million on an annual basis, and that's on the belief that the added financial flexibility after paying all expenses could come in handy, especially in volatile times like now. So next, we have net profit margins that need to be above 15%. Higher profit contribution really helps us find companies with maybe competitive advantages, or an attractive operating model. Lastly, it could just be an exceptional ability to properly contain operating cost. So ROE, or return on equity, helps gauge how effective the company is at creating value from existing assets. So exiting 2019, the broader ROE for the S&P 500 was 13.7% on average. In other words, anything that falls in that needed 15% plus range has really shown a sustainability to generate above average profits for shareholders. So for retained earnings, or net income less dividends, it's used on a relative basis here. So in order to meet the portfolio requirements, retained earnings need to meet or exceed the respective company average over the past 5 years. Lastly, we run a discount cash flow model to help eliminate underperformers. So the recent downward move in the 10-year treasury helps make high quality income streams extremely valuable in our opinion. So this has become extremely crucial in our view, given virus-related implications on businesses have made traditional valuation metrics not as useful, and that's given the expected impact on the denominator, i.e. the earnings, is still in the process of being reset. So on to performance. The big factor I would highlight here is the portfolio has performed well in both up and down markets, and that's since inception. Also, and as I highlighted in the beginning slides, during the first 4 months and year to date, the excess returns here have been exceptional and are listed in the table to the bottom of this slide. So we attribute the performance to the overweight technology and also the battle-tested screening metrics applied to this investment process. So lastly, and as I've shown for different portfolios in the past, we have market capture ratios and batting averages. So when you look at this in conjunction with excess return stats, I think you can see where and how the alpha is actually being generated. So as you can see, up market rates have consistently been above 100%, which means you've captured more upside than the general market. And the same goes for down market rates. So as a reminder, a down market capture rate of 63% means you've only captured 63% of total market downside during that period. So when you look at both down market capture rates and up market capture rates together, you can see that that's directly contributed to a higher batting average, which is how many days across a year that you can actually outperform your bench. So with that, I hope this walkthrough of the intrinsic value portfolio was helpful. You can learn more about CFRA research and our methodology by visiting MarketScope Advisor or contacting us by phone or email, which is listed on the screen. Thanks for listening, and I hope you have a great day.